Hello and welcome to International Finance Today, where we bring you the international finance news and topics. You are live with Phillip McDaniels.
And I'm Brendan Wu.
And we have a great show lined up for you today. It's July 9th, 2020, and you are live with IFT. 2020 has been a trying year for many around the globe, and there are several global issues that need to be addressed as economies have been rocked on every continent.
But still, some of the principles of the past remain relevant in the future. And experts are weighing in how we can keep the dire parts of history from repeating.
One of those principles is the supergrowth model. This is a highly effective tool that has been used to assess the value of a company, project, or other venture and is tied to the cash flows, plowback, time, expected growth, and the discount rate. Brandon, are you aware of this model?
Sure, I am. It can be highly effective. High growth phase leads to high cash flows in the mature stage. Well, high growth usually means high plowback and a high discount rate. A low growth rate usually indicates consistent cash flows with lower risk. A framework to stay consistent and understand economic issues.
On today's show, we will be joined by highly renowned guests to discuss supergrowth model functions and how it can help us understand the economic situations in the past and today. The first of which is Byron Clarke of Canada. Byron, welcome to the show. So with Byron, we'll be discussing the South Sea bubble. This is a very interesting case from centuries ago, but the lessons learned from it can still be harkened today in 2020.
What was the South Sea bubble? Well, to explain this part of history, we need to go back over 300 years to Great Britain and talk about the South Sea Company. Britain had been growing internationally and fighting a lot of wars, and because of this, they were drowning in debt. The South Sea Company was created to basically buy up government debt in exchange for shares. The South Sea Company was given a monopoly on the South Sea region, but didn't really have any cash flow, so they had to figure out a way to manufacture value. They pushed shares to members of parliament in order to create a conflict of interest. With the government as their puppets, they were able to inflate growth and the price of shares even more. The promise of unimaginable growth led to bad investments and extreme hubris throughout the country. The overinflated growth eventually became one of the biggest bubbles in history.
So Byron, thanks for being here with us.
Thanks for having me.
All right, how are you doing?
Yeah, things are pretty well. Yeah, thank you for asking. How are you?
I'm good, thanks. Yeah, so we're talking about the supergrowth model. And what we're going to be discussing today is just the South Sea bubble, where the supergrowth model can be applied throughout. So can you speak a little bit about the model itself, and then we'll get into the situation?
So the South Sea bubble was something that happened about 300 years ago in Great Britain. Basically, what we're looking at today is how the South Sea bubble affected the growth and debt, how the cash flow was affected from the company, how there was so much conflict of interest that was going on that really affected the growth of the discount rates, how the debt led to the funding of bad projects, and basically how an extreme bubble was formed over this trading company. We're going to go right into these details to really understand how the growth model can be used, even from something so far in the past.
So this was involving the British Empire. And at this time in history, the British Empire was everywhere. They were warring with everyone. They were on every single continent. So they were kind of expanding, or as you could say, growing. So can you talk about the growth a little bit?
Sure. So the British Empire, as you said, was in a high growth phase. You could probably argue that they were a mature country at the time, but realistically, they were trying to grow outside of Europe and around the world. They had phenomenal growth because they were going to, India, the Far East, and they just discovered in the last few hundred years the new world. And this was kind of unprecedented growth that we kind of take for granted these days because, we see growth all the time. But realistically, back then, it was something, that hasn't been seen before. With their colonization and growth outside of Europe, this meant armies and costly wars, as you mentioned. They were always fighting against France and Spain, who were also trying to be dominant at the time. Because of this, there was really high risk for these kind of growth models because, who knew who was going to win these wars? The growing G was basically coming from expanded territory at this time. There was increasing discount rate because of all the things that were happening, and because they didn't really know what to expect in the new world. And basically, to fulfill this high growth without increasing productivity at home, which wasn't really sustainable, they were having their expenses outgrow their growth. So they were, going to the new world and buying new ships and warring, paying their soldiers and all this kind of thing. So with all this debt, they had to figure out a way basically to get rid of it. They had about 5,000 pounds left, and they had a huge amount of debt, about 31,000, which at the time was a huge deal. So basically, to get to the mature phase, they had to take advantage of the world trade. They had to grow their production and efficiency, and basically they had to defend their status in the market without having to fight too many wars, so they could reduce their discount rate, their risk rate, and have a bigger, wealthier empire.
Yeah. So one of the ways that they did this was through this company, the South Sea Company, that you're going to speak on. So what was their role, and how did that shape this particular scenario?
So basically, the South Sea Company was created to get rid of British debt. So the South Sea Company would buy British debt in exchange for shares. So basically, you give me your government debt, and I give you the same value of shares in the company. Okay. So with these debt concerns, they allow the South Sea Company to purchase the government debt in exchange for shares, and basically had a bidding contest with the Bank of England. So they gave extremely low discount rates and interest rates for the British government. And they also awarded a monopoly to the South Sea Company. Now, at the time, this was a huge market. People thought this was going to be, the next East India Company. They had basically a monopoly from Central America all the way to the bottom of South America. Now, you can imagine with all the gold coming out of Peru and things like that at the time, how inflated the growth must have been, because no one really knew how much gold was going to come out of this place. So it was crazy. So the promise of unimaginable riches in the New World and the lies they were telling them, saying, we have contracts with Spain and rights to Peru and, all these kind of things from the directors of the South Sea Company were enormous. There was a massive conflict of interest to achieve this growth and basically to get the public to depart from their wealth and invest in the South Sea Company. Now, after some time, to get to a mature phase, they wanted to take advantage of world trade, continue future growth by, having trade with the New World and things like this. And then they were going to defend their status in the market without having to fight too many wars, making treaties with Spain and all these kind of things that really were being falsified at the time.
Okay. So with their role, particularly with the British government, and basically having a monopoly over those particular areas, didn't this create more of like a conflict of interest?
Yeah, so this is where the story gets a little bit exciting, because now politicians are getting involved. So everybody's lying. They're saying we have contracts and we have, lack of taxes and fees that we need to pay to Spain, even though the King of Spain was just like, this is not really happening. They were saying that they'd have increasing shipments year after year. This was really crazy. They were just making up growth. They were giving the public whatever they needed basically to get growth. So the risk seemed very low. And the success of this empire was creating a hubris with the public, basically. So the East India Trading Company was very successful. And, people were trying to get in at the bottom of this. So the government refused to fight off the irrational optimism, and they really created inflated G for South Sea Company. So with basically no cash flow, the South Sea Company could basically plow back anything they wanted. They would just say, we're just putting all the money into the company and whatever to increase the growth because of all these riches that will come after some time. And they were just taking as capital gains from the directors and the people who invested early. People were just buying and selling and basically, similar to the dot-com bust in the early 2000s. So the members of parliament started investing their own money in funding the company, and they have no choice but to push this narrative to keep the growth high. So if we want to go back to the mature phase again, and basically the cash flow during the mature phase would be enormous because of all the high growth investing that they've been doing now, leaving all these shareholders extremely wealthy in the future.
But there was no cash flow at the time, really. This is kind of a perceived cash flow for the future, correct?
Well, there was a little bit of cash flow. Basically, what they were having is the 4% off the government debt. But realistically, for the growth rates, it was almost nothing.
All right. So for these particular, projects that could possibly come up, that they were going to, I don't know, basically just kind of keep their stronghold on. Can you speak a little bit about that?
Yeah, so basically you can imagine with like extreme growth, we're going to have a lot of other projects coming into the market.
Mhm.
So with the unimaginable success and the high growth of the company, of the South Sea company, the present value is extremely high. So this got everybody thinking like, hey, I can just make up a company with no productivity and just sell it to the public. So you can imagine now you have all these crazy ideas, like for example, flying machines, which wasn't something that happened until the early 1900s, really, and got exciting at the end of the 1800s. But realistically, like this, way before this. So the hubris was really high. Nobody wanted to be left out. Other companies were opening, promising crazy things, like the flying machines. And the success of the South Sea companies led investors to believe that they couldn't lose. The G was just going to remain high forever, and really there was no risk. So the discount rate was extremely low, creating the present value to be extremely high. Now with this, the Parliament really got into some bad stuff. So because they knew that this was going to happen, they just started destroying these companies. They were basically just burning these companies to the ground. So now you can imagine investors going in and saying like, hey, the government will get rid of all these bad companies. So like really there's no risk. The government's not doing anything for the South Sea companies, so it must be great. So they were getting even more hubris towards the South Sea company, saying, these guys are amazing. Let's just keep investing. We can never lose. So this allowed the G to stay high for a long time and the R to remain low. So of course the present value is going to continue getting higher and higher and higher. So the government also looked at this as saying like, hey, we can't allow our new monarch to fail either. So we need this new monarch to be doing well. So we need to increase the G even more to ensure that the monarch, looks good in front of the people. So you can imagine the conflict of interest here. It's basically like, I don't want to say it's like an election, but if they lose trust in the monarch, they might lose trust in the system. All these politicians might lose their jobs, whatever. So there's a huge amount of interest that goes along with this.
Well, obviously with that, and a lot of this was orchestrated by Mr. John Blunt, and everybody believing in this particular this company and this model. The center can't always hold, right? And so this was, in other words, creating a bubble, correct?
Yeah, so you can imagine with like extremely high G and extremely low R, the valuation is quite high. But realistically, they had no cash flow. They had no legs to stand on. So once the G started coming down and people thought, hey, is this really growing that fast? So now the risk starts going up. They're thinking, hey, this is a little bit riskier than we thought. So of course the present value is going to go lower. So if we look here like at stage one where the monopoly is granted, let's just say that this is kind of like what you'd expect from a company that would have high growth. At the time, realistically, if they lose a few boats, that's a high amount of risk. So we have a high risk rate. We have a pretty high growth rate. And, it seems quite reasonable, even though the valuation is still quite high. But when we get into like conflict of interest, when we start increasing G and decreasing R, even with the same cash flows, you can see that the valuation gets higher and higher. So now we're in we're getting close to bubble territory. But later on, when the government really starts pushing it, and this is really the valuation of at its peak, $200 million. And at the time, this is about $4 trillion now. So you can imagine this valuation, 300 years ago is crazy high. So that means the G must have been, basically 130% and R 10%. This is crazy stuff. So you can imagine what happened. Bubble breaks, everybody loses their shirt. This is the first big crash and really destroyed the wealth of so many different people.
Yeah, so this was one of the first major crashes that was ever recorded and documented in depth, such as this. What are some of the lessons that you think we can kind of take away as far as the different elements that are involved?
So I think it's important to look at some other bubbles. So if we can look at the tulip, for example. The tulips went really high and went down, they burst. The dot-com bubble was similar. What do these have in common? They have inflated growth and no real cash. So, you have no cash, you have inflated growth, and people think they can't lose. So the risk, perceived risk, I should say, is very low. So the present value realistically should be really low for these companies because the risk should be quite high. But because the growth is extraordinary and people don't really know what's happening, they just put all their faith into one basket, more or less. So if you look at this South Seas company, you put all your money into this, thinking there's no risk and there's nowhere to go but up. So realistically, when it crashes, what happens? You lose your shirt. So I think the lesson to look at this is basically, if you look at a company that has no cash and so much promised growth, your risk rate should be a little bit higher. Don't think you can't lose, because we've seen these events again and again in history, and realistically, it's going to happen again and again if it's something new that people think they can't lose.
Yeah, absolutely. It just goes to show you that all of the elements within that super growth model are very important to consider. There's one that can't be ignored while the other is being attended to. And this is a great example for the South Sea Bubble. Byron, thank you for joining us today. Thank you for giving us some insight on that South Sea Bubble mark in history. And, hopefully we can take from this, especially the lessons learned. And hopefully history won't repeat itself. So thank you for joining us.
Thanks for having me.
All right.
COVID-19 is without a doubt one of the biggest issues of this generation. Not only are people worried about their health, but also their finances. Over the past few months, the world has basically shut down with no real end in sight. With little to show in terms of savings, people in many places are locked inside while they wait for their chance to get back to work, travel, and to feel safe. Not only has this put a massive strain on the healthcare systems, but also the economy. With the world shut down, governments all around the world are scrambling to get things back to normal. To do this, they have engaged in stimulus packages and quantitative easing. But this is just the first step. We just don't know how long this situation is going to affect economies around the globe, how many people will lose their jobs, or even feel safe.
So we just have Phil and Byron talk about how to use the super growth model to explain the Southeast correction issue. So let's pass event. We can also use the super growth model to explain what's current and predict the future maybe. So today we have Stanley here with me, and we're going to talk about COVID-19 and how it affects our current situation. So let's welcome Stanley.
Thank you, Brendan. And then I'm going to apply those models we learned from the class, and then trying to apply not just the Byron talk about the past situations, and then we can also apply those models to the current situations. And then I will have the 5 status. The first one will talk about the business cycle. Where are we now? And then how about what the country now, the stages, what the phrases, what the current status are we now? And then second one will be the discount rate. And then talk about the interest rate and the valuation between the markets. And then third one will talk about the quantitative easings, how the QE works through the various channels, and then the changes in the central bank's balance sheets. And the fourth, we'll talk about the national debts. The debt to GDP ratio is approaching the historical record. And then fifth, we'll talk about the wealth inequality, the wage share of the GDP, and then use wealth distributions.
Okay, thank you, Stanley, for giving us the outline of the COVID-19 issue. So, firstly, you're going to talk about business cycle. So, what do you think? Where are we now?
Due to the COVID-19, the virus outbreak causing the economy entering into the phase of recessions. The early 2020s, many countries' global economies were already in a mature stage of expansion, like a last stage of expansions. And then due to the outbreak of COVID-19, it's causing the majority of countries to heading toward a severe economic recessions. And you can see the graph above, and you can see that right now we are in a stage of recessions, and right now through the government stimulus package, and then right now we're going to have a recovery in the economy and going back to the normal economic activities.
So, what's the characteristic of the recession period? You can share with us.
Yeah, the frozen economy activity will have the frozen economy activity, the sales decline, the profit decline. Also, the government will have some stimulus package along the way.
Okay, thank you for giving us very clear of where are we now. So let's look at one of the key factors in the super growth model, as we learn in international finance. That is the discount rate. So, Stanley, what do you think COVID-19 would affect the discount rate?
Yeah, the deficit impact of the COVID-19 on the economy forced the central bank to offer a serious stimulus package in order to keep the economy running. One way to stimulate the economy is to cut the interest rate. The interest rate can also act as an opportunity cost. Low interest rate create low discount rates, lower the cost of capital, but creates higher asset price. The inverse relationship between the value and the interest rate can be seen from the expression of the PE ratio in terms of fundamentals. The risk-free rate in one component of the required rate of return that is inversely related to the values. And you can see the graph below, you can see that the forward-looking PE multiplier expanded sharply in a low discount rate environment, pushing the valuation of the stock market to higher level. And you can see as S&P 500, for example, right now the current PE ratio is about 21, the average is about 15. So the low discount rate environment really indeed push up the valuation of the financial markets.
Okay, so it looks like the P ratio is relatively high, and
Yeah,
according to your chart.
yeah.
So next, when every time facing a recession period,
Yeah,
the American would do what they can do best, printing money, right?
yeah.
Quantitative
Pretty much.
easing. So how QE works through various channels?
Yeah, the quantitative easings will sometimes called as a monetary policy, whereby the central bank injects money into the market to stimulate the economy activities, and then sometimes also, as known, show as the graph says that helicopter money. Yeah, and then how exactly QE work through the various channels. When the Fed does QEs, it announced that it will buy a large stock of treasuries and then mortgage-backed securities. This lead to a enriching of the treasuries and MBS at the Fed's announcements. And then you can see the graph before the QEs, and the Fed don't do anything, and then after QE, they will try to buy a lot of treasuries and MBS through the markets and release a massive amount of liquidity to the markets and try to stabilize the economy activities. And then how do they try to facilitate those financial institutions by injected a massive amount of liquidity to the market and then stabilize the financial markets.
Okay, so it seems that the balance sheet in those major central banks are increasing a lot in the past years.
Yeah, due to the massive amount stimulus package, and then you can see the graph below, you can see the G4 central bank balance sheet was spent, according to estimation, was spending about 28% of the GDP by the end of 2021.
Okay, so after the QE and the disease, what the national debt looks like?
Yeah, after the disease, and then you can see the expansion of the stimulus package will lead to a massive amount expansion of the national debt, and you can see that maybe it will be lead to another crisis, which we'll call the debt crisis. And you can see the graph on the top, and you can see that at the end of 2019, the debt to GDP ratio, you can see the Japan got the highest, about 240%, and the next will be Italy, US, France, and Spain. And then you can see, according to the estimation of the IMF, it will lead to 122% of GDP at the end of this year. This massive amount of debt is greater than during the financial crisis. And when we take a closer look at the US debt to GDP ratio, you can see this is approaching the presidential records. You can see after the World War II, there's no that massive amount of debt accumulated through all the years. And right now it's going to historical records.
So, Stanley, we have seen several financial crises.
Mhm.
What comes after are the wealth inequalities.
Yeah.
So, what do you think of this topic?
Yeah, it seems that after each financial crisis, the gap between the rich and the poor will widen. it seems that wealth inequality will get severe after each crisis. You can see the graph above. You can see that the wages share of GDP normally falls in the recessions, and and then you see the graph below. You can see that it's come on the top of an extended period when the wages for the top 20% of earners have risen rapidly to the rest due to the only the impact of the globalizations and the technology hitting the bargaining power on skilled workers, which means that richer get richer and the poor gets a lot more poor.
Okay, thank you. Thank you for
Mhm.
explanation of the what COVID-19 affect the GDP, the national debt, the discount rate, and all the stuff. Thank you for coming today,
Thank you,
Stanley.
Brandon.
Hi, my name is Phillip McDaniels, and these are our favorites from the course. So, my particular favorite was the lecture on government deficit and national debt. I chose this particular lecture just because I am very familiar with the argument from a United States perspective. However, I was not so aware of the particular issue from another country's perspective. And this lecture provided some insights to particular cases of the government debt, deficit spending, as seen through another country's eyes. So, one particular case was the Japanese deficit case, where it highlighted the fact that the Japanese government was providing stimulus to its own people as far as like the debt that was owed, as well as how the economy did not get any particular significant gains from the stimulus. However, the GDP was actually affected. Um, it was very interesting to find out that how demographics and culture drive different countries to rely on debt to support their citizens, as well as the political aspects of this, especially in this particular year in 2020 with COVID 19. There's been a lot of deficit and stimulus spending by countries, especially for the United States standpoint. And it drives the political conversations in a lot of ways, especially in election years, which is what we see back home in the United States. So I thought that that particular lecture was interesting. It'll be interesting to see how it all unfolds in the future years to come as far as the deficit and debt spending from this year, and as well as opposed to other countries and how they're handling that issue. So that was my favorite lecture and piece from the course.
So, hi guys, I'm Brendan Wu. I'm one of tonight's hosts. And about my favorite part of this class, I think when professor applied the growth equation for the personal decision, especially deciding whether we should enter an MBA or not, I think that's very interesting for me. Because when I joined the MBA, I didn't think that much. I just want to get a nice degree. I probably can raise my salaries. But after the professor explained the super growth equations, I came home, I put some numbers on it. I think it's totally worth it. So
Hi, I'm Stanley Lin, and then below is my favorite parts. And then my most favorite part will be talk about the business cycle. It's not only apply to business, but also apply to countries, products, and then we can also even use in the individuals, and we can use this cycle to measure how do we do the decisions throughout each stages. For example, maybe the younger stage we should invest aggressively, and then at the older stage will be have invest less aggressively than the younger stages. And then also we can how to and the second one will be how to we find the sweet spot between the over investment and the under investment. Not to invest too much, also not to underinvest in different aspects, and then also the international trade. International trade, how the nation use their comparatives advantage to exchange resources. And then, but the most important concept we learn from the class is that we have to having a framework in mind to understand the world. Without a framework, it's easy to speak in nonsense and a likelihood to misunderstand what is happening. Professor Jason gives us various examples from history to help us to have a deeper understanding about logic behind each cases.
Hello, my name is Byron Clarke, and my favorite part of the course was the Greek tragedy case. I found the lessons from this case very interesting based on Greece overvaluing their currency and how it wasn't helpful for their overall economy. Now, Greece inflated their currency and eventually lost the ability to competitively export their goods. Basically, they had high costs and low productivity. And with Germany next door having really high productivity and lower costs, this was really a disadvantage to Greece. Now, Greece got into a lot of trouble financially as well. And because of this, Germany and France and other European countries had to bail them out. They couldn't let Greece go bankrupt because if they did so, they would basically be bankrupting the banks of their country. Greece couldn't go to the money gods, as we learned in class, because they didn't have their own currency. They're on the euro. So basically, they would have to convince all the other countries to be able to go to the money god and get more money. This is just not possible for a country like Greece. It's not like in the US or Japan where they can go to the money god, basically borrow for however much time they need to, and bail out the country. I really found this concept of the money god and being able to go there to get money very interesting. And because of this, the Greek tragedy was my favorite part of the course.
We want to thank our guests, Byron and Stanley, for joining us today to talk about the supergrowth model and how it relates to the South Sea bubble as well as the COVID-19 pandemic. We can use this supergrowth framework to discuss other areas of economics. These are things like valuation, trade and currency, national debt, interest rates and inflation, demographics. What else, Brandon?
Like something like global investment, inequality, business cycle, and government policies. So we use the framework to keep our arguments consistent. We want to ensure that there is a basis to make optimal decisions and to seek our reasons why others are suboptimal. By using the framework, we can avoid contradictory statements and our actions to maintain consistency.
All right. Yeah. So we want to thank you for joining us today on International Finance Today. My name is Phillip McDaniels.
I'm Brandon Wu.
And we'll see you next time.
See you. Check out.